Hello and welcome to the Tax Roundup for November. Inside this month, we're going to take a look at the San Remo Heights case, an interesting case that's come through the AAT, looking at the GST treatment of vacant land sold by a company. But of course, the big news this month is the 2021 budget, the status of the announcements, and we'll also take you through a walkthrough of the initiatives, and a number of those have already been enacted. So it's across to you, Michael.
Well, this month we have seen the federal budget handed down, albeit quite late compared to most years, and there are a number of tax-related measures that were announced on a budget night. Now, some of those measures we'll have to wait and see before we get a little bit more detail. For example, we're still waiting on more detail on the proposed changes to the CGT treatment of granny flat arrangements. We're waiting on a bit more detail around the corporate residency rules. But we do have not only more detail, but actually legislation that has been passed on a few of the major tax matters that were announced in the budget. That includes the immediate write-off rules, a further expansion to that system, the loss carryback rules, and also the R&D tax incentive rules. Let's just have a quick look at some of the key features of that immediate write-off and the loss carryback rules. First of all, immediate write-off rules. Now, this is an area that is in some ways actually quite confusing because we've had so many changes to the way these rules work over the years. Basically, what these new rules do is from 6th of October 2020 through till the 30th of June 2022, entities that carry on a business and have aggregated annual turnover of less than $5 billion will basically be able to claim an immediate deduction for a whole range of depreciating assets with no cost limit. Now, in some cases, a cost limit will kind of still apply because when we're dealing with luxury cars, we still will need to consider the luxury car limit. But beyond that, really, this measure is pretty open in terms of what the asset might cost. So no longer a $150,000 threshold that we had just previously. We're into an unlimited cost threshold space for a while. Now, there are some assets that won't qualify. For example, we will still need to distinguish between depreciating assets and capital works expenditure. Capital works expenditure won't qualify for these immediate write-off rules. Certain assets that are dealt with under different systems like low-value pools and software development pools, certain concessional depreciation rules for primary producers, those will still apply separately to these immediate write-off rules. But in some cases, taxpayers in that space will still have access to quite fast depreciation rates, in some cases immediate write-offs for some of those assets anyway. For small business entities, they do have access to this immediate write-off with no cap as well for the same time period. The additional thing that happens for small business entities is for those entities that have a small business pool, the entire pool balance will be written off at the end of the 2021 year and the 2022 year. Although having said that, there may not be anything left in those pools for those years. It will just depend on the situation of clients at the time. So that's the immediate write-off rules. We're looking at some really key dates in terms of when assets start to be held and start to be used for business purposes, income producing purposes. We will need to check those details with our clients. But overall, that legislation is in play and the rules are live, so we can act with a fair bit of certainty and confidence with those at the moment. The other thing we'll touch on briefly is the loss carryback rules. Now, some of you might recall that back under the Gillard government, the loss carryback rules were introduced and they were only there for a very limited period of time. They were repealed quite soon afterwards. The government has reintroduced this concept of a loss carryback system, but just note that it is limited to companies or entities that are taxed as companies. Effectively, what the system does is, for a limited period of time, it will allow companies to use losses to basically get a refund of prior year tax that has already been paid. So we're looking at whether a company has a loss for the 2020, 2021 or 2022 income years, and then looking at whether the company has some tax payable in the 19, 20 or 2021 year. And in those situations, there may well be an ability to carry back losses and obtain a refund of tax already been paid rather than carrying those losses forward to future years. Now, probably the main thing I just want to mention at the moment is there has been a bit of confusion around the practical application of these rules and how quickly clients can actually receive a cash refund under this system. The way the rules work is you don't go and amend prior year returns. you will be including the details of the relevant tax offset. It operates by a refundable tax offset in the 2021 or 2022 tax returns. So even if your clients do have some losses, say from the 2020 year, and they had some tax payable in the 19 year, for example, really there is no ability to claim an immediate refund of that 19-year tax. You've really got to wait until the 2021 tax return is lodged. So in terms of immediate benefits, there'll be a little bit of a wait. It won't be an immediate benefit, even for those clients who may well take advantage under the system. Now, there are some eligibility criteria to access that loss carryback system. You do need to have a pretty good compliance record in terms of your obligations. Lodgement obligations need to be up to date pretty much. And it is optional. You don't have to carry back losses. There is the option of carrying them back or carrying them forward. It's really up to the company to decide what it wants to do there. So the new immediate deduction rules for depreciating assets, the loss carryback rules, they have been legislated. The bill passed through Parliament quite quickly, has received royal assent. So those rules in both cases are live, and we can start working through those rules and see what benefits they might provide to our clients now.
Now across to that San Remo Heights case and the GST treatment of vacant land sold by a company.
And one of the interesting cases we've seen through the last month or so is the San Remo Heights case, and it dealt with a taxpayer that was selling some lots of vacant land. Now, the taxpayer was a company. It was a company that was registered for GST. And when it sold the lots of land, it argued that no GST should apply because those sales were not made in the course or furtherance of an enterprise that it carried on. Now, the company, as I said, was registered for GST. It did carry on enterprise activities. It carried on some grazing activities. It had some rental activities. But these particular lots of land, these blocks of land, had not been directly used in connection with those particular enterprise activities. So when the company sold the land, as I said, the company took the position that it should not have to pay GST. Now, in order for a supply to trigger a GST liability, it needs to be made in the course or furtherance of an enterprise. There needs to be some connection with an enterprise that's being carried on. Now, what we typically look at is whether those assets that are being sold have been used in connection with the taxpayer's enterprise. Now, in this case, as I said, the taxpayer argued there was no connection. The ATO disagreed. The ATO took the view that even though these lots had not specifically been used in rental activities or these grazing activities, that didn't mean that they were not or had not been used in connection with an enterprise. Well, the AAT agreed with the ATO's view, and basically it came down to some extent, a question of evidence. The AAT took the view that even though these lots had not been directly used in those grazing activities or rental activities, they had been held in connection with broader enterprise activities. The company had been involved in the subdivision of land before. So in the absence of very clear evidence that these lots were not held in connection with an enterprise, the AAT took the view that they were sold in the course or furtherance of the company's enterprise and that GST should apply. Now, again, we see in lots of these cases that it's often a question of evidence that kind of is the deciding factor. Rarely we're seeing kind of complex technical arguments. In this case, it was, again, a question of evidence. And I guess in a case like this, what you'd be looking for is evidence that maybe the property had been used only for private. Given that this was a company, that argument is more difficult. General when it's an individual selling land and you can show that it has only ever been used privately. So that's that San Remo case. Just be very careful, particularly when property is held by someone who has some experience or involvement in property development activities. It does make it much harder to be able to argue that sales of land are not subject to GST.
And that's the tax roundup for this month. Knowledge Shop members, PD is on the 1st of December. We have a sensational lineup of speakers. Registration is now open, so don't miss out. If you're not a member of Knowledge Shop, then give the team a call on 1800 800 232. We'd love to show you what we have on offer. Speak to you soon.